Build your dreams, live rich, and leave rich.
Welcome to Live Rich and Leave Rich. I'm Krish. My whole philosophy is pretty simple. Living rich isn't about having the fanciest car or the biggest house. It's about living with financial peace of mind. And one of the biggest things that gets in the way of that peace is fear, especially fear of what we don't understand. So today, we're going to tackle a topic that brings a ton of excitement, but also a lot of fear to so many Indian families, the world of small cap mutual funds. Okay, before we dive in, let's get our usual but very important disclaimer out of the way. Everything we talk about here is purely for your education, to help you understand these ideas better. But when it comes to your own hard-earned money, please always talk to a SEBI-registered financial advisor. They're the only ones who can look at your specific situation and give you the right advice. All right, let's just go ahead and talk about the elephant in the room, shall we? For so many of us, when you hear the words small cap, what's the first image that pops into your head? It's a casino, right? You think of shady penny stocks, basically throwing your family savings onto a table on Dalal Street and just hoping you get lucky. The big fear is that it'll all vanish overnight. Well, our main goal today is to take that myth and completely dismantle it. But what if that whole casino idea is just wrong? What if when you pull back the curtain, you find that a small cap fund is actually one of the most sophisticated, research-heavy wealth hunting machines out there? Stick with me for a bit, and I'm going to take you behind the scenes. We'll break down exactly how these funds are built, how the experts go out and scout the hidden corners of India for tomorrow's giant companies, and how you, potentially and safely, be a part of that incredible growth. So, to really get a feel for how these wealth hunting machines actually work, we don't need complicated formulas or a bunch of jargon. Nope. All we need is an analogy that pretty much every single family in India knows and loves, and that's cricket. So here's how to think about it. A large cap fund, the one that invests in India's biggest, most famous companies, is basically the Indian national cricket team. It's packed with proven superstars. Your Virat Kohlis, your Rohit Sharmas. They're stable, they're reliable, they're world-class. You can count on them to perform. But let's be real. Their period of explosive 10 times growth, that's probably in the past. They're already legends. Now, a small cap fund, that's a whole different game. Think of it as scouting all of the under-19 state teams across the country. These are 16, 17-year-old kids just full of raw talent and massive potential. Now sure, a lot of them might not make it. Some will just fade away. But somewhere in those teams are the next legends, the next Sachin, the next Virat, just waiting to be discovered. And that right there brings us to the most important idea. A small cap fund manager isn't a gambler rolling the dice. No way. They're a professional talent scout. Their entire job is to travel the country, watch all the matches, analyze every player's technique, and use decades of experience to spot that future superstar before anyone else even has a clue who they are. It's not a bet on luck, it's a bet on potential, backed by an incredible amount of research. Okay, so that cricket analogy is great, but how does this whole scouting thing actually work in the world of finance? Well, it all starts with the official rulebook, and that rulebook is written by our market regulator, SEBI. So let's start by figuring out what the word small really means according to the rules. It all boils down to a very simple concept called market capitalization. Now, I know that sounds like our first piece of scary jargon, but trust me, it's super simple. Just imagine you wanted to buy a whole company. I mean, every single share. Well, market capitalization is just the total price tag for that company. You figure it out by taking all the shares the company has issued, and you multiply that by the current price of just one share. That's it. It's just the market's way of saying, hey, this is what this whole business is worth right now. Now here's the beautiful part. SEBI has made this incredibly simple and totally strict. There are no opinions or gray areas here. They just take every single company listed on the Indian stock exchanges and rank them by their market cap, from the absolute biggest all the way down to the smallest. And the rule is crystal clear. The top 100 biggest companies are large caps. The next group, from rank 101 all the way to 250, are mid caps. And then by law, every single company from rank 251 onwards is officially a small cap. It's that simple. No debate. But hang on. This is the part that blows most people's minds. A small cap company in India is not a little roadside shop. It's not your local Kirana store. Our economy is so huge that a company that's ranked, say, 251st or 300th in the country can still be a massive, massive business worth 5,000 crores or even more. These companies can have factories all over India, thousands of employees, and be the absolute leader in their specific industry. They're only called small when you compare them to absolute giants like a Reliance or a TCS. Okay, so we now know that the pond where our scouts are fishing begins with company number 251. But with thousands of companies in that pond, how on earth do they find the real winners? This is where the real magic happens. It's called active management, the real hands-on scouting. And it is the complete opposite of a passive index fund, which just runs on autopilot and buys a little bit of everything. You see, a small cap fund is like a handmade suit. It's put together with intense, on-the-ground detective work. These small companies aren't on the news every night, so the fund manager and their team can't just sit in a fancy Mumbai office reading reports. They have to get their boots on the ground. I mean, they'll literally fly to a remote town to walk through a company's factory, to touch the machinery, to see the quality of the product with their own eyes. They'll sit down for hours with the company's founder, the CEO, and basically interrogate them, trying to understand their vision, their ethics, their entire game plan. They even talk to the company's suppliers to make sure they pay their bills on time, and they'll talk to customers to see if people actually love the product. It's a full 360-degree investigation to figure out if this small company has the DNA to one day become a giant. Now, obviously, it's impossible to do that kind of deep detective work on all 4,000 plus small cap companies out there. It just can't be done. So what the fund houses do is really smart. They do some initial research and create their own research galaxy, let's call it. It's a focused list of maybe 300 to 400 of the most promising companies. That becomes their hunting ground. And they track these specific companies obsessively, day in and day out, just waiting for the perfect moment, the right price to invest and add that promising young player to their team. So the fund manager has found a promising young company. They've done the research, but just like with our young cricketer, with all that incredible potential comes a lot of uncertainty. And this brings us to the most famous, and let's be honest, the most feared thing about small cap funds, their volatility. This is where both the crazy excitement and the real anxiety come from. The best way to understand volatility is with a quick nature analogy. Think of a big, large-cap company like a 100-year-old banyan tree. It's huge, its roots are deep. When a big storm hits the market, yeah, the tree will shake a bit, but it's not going anywhere. It's solid. A small-cap company, on the other hand, is like a young, fast-growing sapling. In good weather, what we call a bull market, that sapling just shoots up towards the sky, growing much, much faster than the old banyan tree. But when that very same storm, a bear market hits, that young sapling is vulnerable. It can get knocked down much harder than the giant tree. And that's really because these younger companies are more sensitive to big economic shifts. It's the price you pay for that high growth potential. So, what does this wild ride mean for you as an investor? Well, it leads us to the single most important, the golden rule of small cap investing. You absolutely cannot treat this like a T20 match, where you're hoping for quick sixes and a fast score. No. This is a test match. It demands serious patience, because these funds can drop by 30, 40, even 50% in a bad year. You have to have a long-term mindset. And I'm not talking 1 or 2 years. I'm talking a minimum of 7 to 10 years, or even more. That's the amount of time that little sapling needs to recover from the storms and get back on its high-growth journey. If you don't have that kind of patience, the big risk is that you'll panic and sell right at the bottom and turn what was just a temporary loss on paper into a permanent loss in your bank account. All right, now for what I think is one of the most fascinating and honestly kind of backwards parts of this whole story. What if I told you that one of the best signs of a really well-managed small-cap fund is when it suddenly stops taking your money? I know, it sounds completely crazy, right? But it's actually a critical move they make to protect all the investors who are already in the fund, people like you. Let's use one last analogy, the fish in a small pond. The entire small-cap universe, remember, is like a small, delicate pond. The fund manager is the fisherman. And a huge flood of new money from investors, let's say 2,000 crores, is like a giant fishing net. Now, if that fisherman tries to use that giant net in this small pond, they don't just catch the fish. They stir up all the mud from the bottom, they completely disrupt the ecosystem, and they can cause total chaos. In finance, we call this a liquidity constraint. Okay, let's walk through exactly how this happens. Imagine a fund gets really popular and boom, 2,000 crores of new money comes flooding in. The manager now has a problem. They are forced to invest that cash, but they're fishing in that small pond, remember? There aren't unlimited shares to buy. So when the manager takes that huge pile of cash and tries to buy a big chunk of a small company, what happens? That massive demand artificially blows up the stock price. The price shoots up, not because the company is suddenly doing better, but just because too much money is chasing too few shares. This forces the fund to buy at an unfairly high price, which hurts the long-term returns for everyone who has already invested.
A responsible manager sees this danger coming and does the only brave thing they can do. They close the doors to new lump sum investments. They're choosing to protect the pond and their existing investors. It is the ultimate sign of a disciplined manager.
Phew, we have covered a whole lot of ground. So before we wrap up, let's do a super quick jargon buster to make sure the 4 key terms we learned today are crystal clear, with zero confusion. First, market capitalization. That's simply the total price tag of a company. Second, SEBI categorization. That's the official ranking of companies by their size. Third, volatility. That's just how wildly an investment's price can swing up and down. And finally, liquidity constraint. That's when it gets hard to buy or sell a lot of stock without messing up the price for everyone. See? Simple. Look, understanding how small caps really work is a massive step forward, but it's still just one piece of the bigger financial puzzle. To see how a powerful tool like this fits into a complete, long-term plan for your family's future, I really invite you to explore the Legacy Diary. The link is right there for you in the description to continue your learning journey with us. If this explainer helped clear up some of the mystery around small caps for you, please do me a favor and subscribe. And maybe share it with one person in your life who you think needs to hear this message. Our whole goal here is to replace financial fear with financial knowledge. Thank you so much for your time, and always remember our philosophy: live rich and leave rich.